Before we get into today's video, I have a huge favor. Ladies and gentlemen, nearly 72% of you are watching my videos and not subscribing. So do me a quick favor before we get into this video, just hit the thumbs up and just subscribe to the channel, help the channel out. I don't charge anything. I go into deep analysis on your request, and today's video is on subscriber request. To say today is an interesting day would be pretty much an understatement, as GameStop skyrockets 80% in one single day, as Roaring Kitty is now pushing the meme stock back up to newer highs, with AMC now being a participant in this rally as well. We know the AMC apes are going to be pounding their chest here really soon, and this is obviously a sign of a very healthy market. Oh my god. Obviously, this is just ludicrous craziness that's taking place, and the gambling and liquidity is just showing us that there's still tremendous liquidity out there, still just a lot of gambling out there, and this just goes to show that the market can be extremely irrational for an extended period of time. So let's get into what today's subject is about. So we have CPI and PPI just a few days away, with Fed speak also on the table. Guide us to what's the next move here for the Feds, and do we really get it? Are we really getting a good grasp on inflation with the recent tick up, or is this now the new trend that inflation is ticking back up and that rate hikes could actually be back on the table? With the meme stock mania now ticking back off, we're seeing that small caps, the Russell 2000, is also now peaking up here. And this could be a signal of a few different things. I'm not going to discount the fact that AMC and GameStop are skyrocketing here. I think Roaring Kitty has a lot to do with this, but at the same time, I also think that this could be just a relief rally, short covering, and the fact that inflation could be coming down and rates now could actually be looking like we could be getting cuts sooner than later. And so the market's front running this, and that's why we're seeing this crazy behavior. So let's get to what the point of this video is. I've had a bunch of different call outs. So today we're going to dive into VF Corp. This was over an $80 stock, now bouncing up over 5% on the day to $13 a share. And the 52-week low in the stock was $11.91. They recently cut their dividend. They've had a couple bad years, and now are we starting to find a bottom here? From the chart, it does look like it's building a base. We don't want to take a one-day move off of anything, but what we want to do is take our emotions out of everything and really figure out what the company's capable of doing going forward. Okay, so past performance is not indicative of future performance. So what we have to do is figure out where the business lies today and where can it go going forward. For the record, I'm not a huge fan in some of these clothing companies because I think there's a huge dynamic taking place within direct-to-consumer clothing brands and using influencers, and it's just very competitive, and it's very hard to figure out who's going to win this landscape, because there's no real way to get a moat or competitive advantage unless if you're kind of like a Nike and you've really cornered a certain market. But when I look at the brands that VF Corp has, like Vans, North Face, Timberland, and Dickies, these are really popular brands that people actually seek out. They try to go find them, and these are actually higher quality brands. You know they're going to last. They have quality material. They're a little bit more expensive than your average clothing brands, but they also last a lot longer, and they're way more durable, and they have a huge following. The people that like these brands stay loyal to these brands. And so this brand was founded in 1899. It's been through the good times and the bad times. And what we're starting to see here is that we're starting to see a peak in revenue growth, and we're also starting to see dysfunctions in earnings per share. And on this channel, what do we always talk about? Stock price will follow earnings per share. And so kind of just to highlight exactly what I was talking about, in 2014, they were doing $11.8 billion in revenue. In 2022, they're doing $11.6 billion in revenue. So revenue has really just been nothing but flat across the last 7-8 years. And you see a wild range when it comes down to earnings per share. And when we bring it down to a free cash flow, it was more efficient. It was a way more efficient business in 2013, 2014, 2015 than it is over the last 3 years. And so this is why we've seen a stock go from $80 a share down to $13 a share. So currently we're kind of getting an idea of what's going on. Been flat revenue growth for many years. EPS has been all over the place. Free cash flow is less efficient. And then on top of that, they slashed their dividend. Not a lot of good news around the stock, but they do have a tremendous amount of brands. And just like we've talked about with a lot of the streaming companies, at some point in time, this IP that they have, the intellectual property, it becomes harder and harder to put a price tag on, but it's definitely worth something. Sentiment around the stock is all over the place between $12 and $26, which could make it a buy today. Basically, stock analysis has them kind of Basically, stock analysis has them getting their EPS back on track, along with some revenue growth going forward, about 5% revenue growth. But as we've seen over the last 8 or 9 years, they haven't been able to really get this on the right track. So what has changed in order for them to kind of get the ball rolling in this direction? I'm not so sure. The recent quarter that I put up was February 6, 2024, and revenues were down 16% to $3 billion. And they were saying the quarter was negatively impacted by shifting in timing of wholesale deliveries, loss of 11 cents a share versus of $1.31. Adjusted earnings came in at 57 cents. They are reaffirming free cash flow of $600 million for full year 2024. The good thing is this is not a company dumping a tremendous amount of shares out on the market. They have $988 million in cash and cash equivalents. So now comes the art of investing here, because this is a very, very tough one to figure out. Net debt is growing, going from $4.9 billion to $5.8 billion outstanding. Here's the other problem. Their cash flow is definitely coming down, going from a company that used to do about $1 billion of free cash flow down to $600 million in free cash flow. A 10 times debt to free cash flow, which is higher than I like to see. I like to see it under 3.5, under 4. On certain companies that I think are turnaround stories, I could reach 5 or 6, but this is getting to a level where I don't think it's a great balance sheet. And I'm being very, very cautious in my guidance here. So what I'm doing, the picture I'm painting is that this company is heading in the wrong direction. It's going to take multiple years for this to kind of get righted here. So by 2026, I think they figure some things out. I think they get that free cash flow right around that 600 million mark. But from there, I do think there's going to be growth potential going forward of roughly 4 and 3%. Okay, I'm not doing anything extravagant here. This is basically me meeting some of the analysts in the middle, saying some analysts think they're going to do 1% growth. Some analysts think they're going to do 5 to 6% growth. I'm going to meet in the middle and say they're going to do about 1 to 4% growth. We can see here that basically 10 times a 10 multiple makes a lot of sense. So we're going to put a 10 multiple on it. So now the biggest problem is going to be figuring out margins on this company. They've been all over the place. Anything from 7.5% EBITDA margins to 17% EBITDA margins. So here's what we're going to do. We're going to work backwards, saying that they're going to do about 8% EBITDA margins for the next few years, bump it up to 10% EBITDA margins, and then get it to 14% EBITDA margins. I think this is pretty realistic expectations for the company. If you think they're going to be a turnaround story, if you think that this is a company that's going to keep kind of going on the path that they're going on, and I would avoid this altogether. So we'll go 8, 10, 14 EBITDA margins. We get our stock price of around $13.70 from a free cash flow standpoint and $12.80 from a multiple of EBITDA. Currently, the stock is trading right around $13. I think for me personally, this gets more interesting below that $12.50 mark. Okay, so we've had a big spike in the stock. I would say possibly stay away from that right now. Try to be patient, see if you get a better opportunity, because this is kind of a higher risk story when we start looking at the balance sheet that it's currently covering. When we look at some of the sectors that are down 28% when we talk about vans. As always, guys, hopefully you enjoyed this dive in, and we will see you in the next one.